Hello, everybody. My name is David Andolfatto. I'm with the Research Division here at the St. Louis Fed. I'm here this afternoon to speak with Greg Kaplan, who's at our first annual St. Louis Advances in Research Conference. Greg, thank you for being here. Greg will be presenting a paper entitled Consumption and House Prices in the Great Recession, The Model Meets the Evidence. Why don't you tell us a little bit about the paper, what it's all about, Greg?
Well, thanks, David. Thanks for having me at the conference. So in this paper, we were trying to understand what was behind the boom and bust in house prices that we saw during the Great Recession and the preceding decade or so. So we were thinking, there's generally, I guess, three different things that people think might have been behind the increase in subsequent decline in house prices. Things that, like fundamental shocks, changes in our ability to produce houses or how much we like houses is one possible suspect. The other possible suspect is changes in the credit market, that houses became cheaper just because there were, I guess, looser lending restrictions and different types of people were able to access mortgages that they couldn't. Right. And a third possibility is what I'll just refer to as beliefs. People thought that house prices increased because people thought that future house prices might increase, and that's been sometimes referred to as exuberance or other related views. So we try to use a fairly rich model of household behavior that incorporates what we think are kind of important aspects of the household decision to consume and to purchase households, things like the structure of mortgages, the presence of a life cycle, that people go through periods of life when they want houses more than others, the interaction of owner-occupied housing with rental housing, together with a whole bunch of data on not just house prices, but also looking at what happened in consumption, what happened at leverage use, looking at what happened at foreclosures, to try and come up with an answer of which of these three suspects is most likely drove the movement in house prices.
Right, and so let's see. So you looked at the data. You developed a theoretical model to help you identify which of these forces would be most plausible. What did you find?
So we found that the data, when viewed through the lens of the model and using the model in conjunction with the data, together they seem to point quite strongly towards one of these sources, which is the change in people's beliefs. So we think of that as being that everyone kind of understands that at some point in the future there might be a time when we all really like housing, and that time might be coming sooner than we previously thought. And because of that, there's kind of an agreement that house prices are going to continue to rise for a while, and as a result, that increases demand for housing and pushed up housing prices.
So what was it that led you to the conclusion that these other factors were not important? And in particular, as you mentioned, a lot of people have put a stress on looser financing standards, innovations that permitted certain classes of individuals to obtain financing that wouldn't otherwise. These are very popular theories. What led you to dismiss those as plausible sources?
Right, so it's not that those credit conditions are not important, it's just that we found that they didn't play a big role in moving house prices per se. And the reason for that is that for changes in credit conditions to have a big impact on house prices, they need to have a big impact on housing demand. And need households to want to consume more housing. Sure. And that can really take place, I guess, on two margins. It can take place on the intensive margin, that existing homeowners want to build bigger homes, and on the extensive margin, that people who are previously renting want to move into home ownership. Now, for changes in lending standards to have a big effect on the intensive margin for existing homeowners, it needs to be the case that existing homeowners were previously constrained in their ability to be able to live in the size houses that they wanted to. You need a lot of households who were at the margin would have ideally purchased a bigger house, but were constrained by lending standards. Now, that's certainly true for some households, but it's really just a quantitative statement that it looks like, given the fraction of households in the US population that had low loan-to-value ratios that weren't currently constrained, it's unlikely that on the margin that has a big enough effect on housing demand to move house prices by a large amount. On the extensive margin side of things, I mean, one of the things that's pushing against that is that, for that to be the case, you have to wonder, why does a household who's not currently renting just buy the house that they're living in? Right? So for that, it has to be that there's very strong frictions between the stock of housing that we can use for owner-occupied housing and the stock of housing that we can use for renting. At the same time, we saw big movements in the rent-price ratio over this period. So although house prices went up and came down, rents stayed relatively constant. In other words, there were big movements in the rent-price ratio. So this is really just a quantitative statement that given the size of those movements in rental house prices relative to rents, given what we think are the segmentation in the markets for owner-occupied versus rental housing, that extensive margin channel, while it's there, and particularly there for young households who are on this margin, is just not big enough to explain the really large movement in house prices and subsequent decline that we saw.
I see. So, and why wouldn't have previous researchers captured or realized what you just stated right now? Was it a limitation in their modeling technique, or do you have more data that permitted you to come to this conclusion?
Yeah, no, that's a great question. I think it's a combination of both. Okay. So there are a number of key features in the modeling environment we look at, which we think reflect real important features in the world that matter for these decisions. And a number of previous researchers who'd looked at this question, they've abstracted from these features. So let me just tell you a few. So the first one that's important here is the structure of mortgages. So typically researchers think about short-term mortgages, think about mortgages a little bit like they would unsecured credit. So we want to take seriously that for the majority of US households, they finance housing through long-term mortgages, fixed-rate mortgages. That means when house prices change, no one's really forced to change anything in their repayments unless they want to. The second important thing is the presence of a rental market. Everyone has to live in a house, but not everyone has to own a house. So being able to speak to this extensive margin, we need to be able to think about the presence of a rental market. And the third important feature is the presence of a life cycle. The fact that a lot of the housing demand that exists in the real world comes through just simple things like as people get older, they get married, have kids, they have their housing needs change, and then as they get older still their housing needs change again. Those deterministic movements over the life cycle play a big quantitative role in driving housing demand, and we took those things seriously.
Very interesting. So in terms of your preferred hypothesis about this shift in the perceived demand, future demand for housing, I mean, do you exploit regional differences in home prices in your data set? We do. So we don't explicitly have information on differences across regions in people's beliefs about future house prices, but we have some other important information that we can bring to bear on this question across regions. I guess what I'm getting at is this hypothesis that you have. I mean, because we know that home prices behave differently depending on, Florida was a lot different than Missouri, for example. And would your model lead us to believe that Missourians just had different beliefs about the future demand for housing in the state? Or? Not necessarily. No. In fact, there's a lot of evidence that exactly exploits this sort of cross-regional variation. And one of the findings in that literature is that regions that experience the biggest boom and bust in house prices also experience the biggest boom and bust in consumption. Now that's consistent with our model, even if the underlying source of the fluctuation in house prices was the same across regions. And the idea there is that even the same regions, different regions getting hit by the same change in their beliefs about future housing demand, future housing preferences, if their underlying structure of the supply side of the housing market differs, then that can lead to different movements in equilibrium prices. And in fact, what we do in the model is we replicate the Florida compared with California compared to New York example by constructing different regions with different elasticities of housing supply and then generating different big boom busts in house prices and making sure that the corresponding movements in consumption across those regions is consistent with the evidence. Very nice. So just to conclude, do you have I know the work still is a little preliminary, but very much so. Do you see what are the kind of broad policy implications that presently or you expect would follow from your findings? Well, I think the class of policies that we speak most to, the so-called mortgage modification programs, some of which were actually implemented during the bust part and during the Great Recession. These are things like the home affordability refinancing program and the home affordability mortgage modification program. These were programs that tried to alleviate some of the burden on homeowners who had trouble paying their mortgages with the intent of simultaneously alleviating their burdens, but also trying to maybe affecting some outcomes in the housing market. So we can replicate some of those types of policies inside our model, and we're going to part of the goal of building a model that's consistent with all this evidence is to be able to use it to say something about what the likely impacts of those policies would be as we go forward. Very nice. Very interesting. Greg, thank you so much for taking the time to explain your work to us.
Thanks for having me.